Volatility really does breed opportunity because what happens is the price moves quite dramatically faster in different direction than the underlying intrinsic value of a business. Keep in mind that business value is determined by the present value of all cash flow streams. This year's cash flow and to the future discounted to the present value. So when price moves so dramatically, and yes, there will be some small changes in value, but it means a big value gap opens up and providing an opportunity for truly long-term investors. So this is a really good time period for value investors defined by those people who are looking at the price of businesses and have the patience and the time horizon to take advantage of this volatility.
And so you suggesting, David, that whether we're talking about Italy or about China, that this is just going to be a one-quarter effect? Is that your expectation?
I wouldn't be able to judge whether it's 1 quarter or 2 or 1.5, but this is something that will pass probably within the year, probably within the half year. And so this will have an impact on short-term earnings. But really, the intrinsic value of a business isn't determined just by the next couple quarters. I kind of chuckled over this, whether we should be buying companies that sell hand sanitizers. I mean, this is exactly the opposite of value investing. Just because a business is doing good in the short term, you have to look at all their cash flow streams, not just what they're going to do in the next couple months. And plus, by the way, in about 6 months, we're all going to have too much hand sanitizer.
So it sounds like you see some real opportunity and some deep value. Give us a sense of where in the world or which industries that might be in.
I mean, to be honest, the same sectors that have been punished and killed, kind of the value-facing sectors, look at the financials in Europe as an example, some of the materials companies, Glencore, look at some of the auto companies. These are businesses that have been punished basically in 2018. And if anything, the value gap has opened even greater as people continue to flock what they perceive as safe, completely ignoring the price of businesses.
David, I see, looking at one of your international funds, that you hold a lot of banks, particularly in Europe. Whether we're talking about European banks or US banks, why are those attractive when the rate environment has only gotten worse over the last couple of months, and there's no immediate sign of when that will turn in a meaningful manner?
You're exactly right. The rate situation, especially in Europe, has been tough for banks. This means one portion of their earnings, the lending spread, gets hit. But banks have other levers to pull, and they have been able to pull them. They've been growing non-interest income. They've been cutting costs. Loan losses have been subdued. And so when you really look at the whole picture, for the most part, most of the banks that we own and are in the quality universe in Europe have been able to slowly grow their earnings. And despite this, if we look year to date, some of these things are off 30, 35% and are at trading at multiples 4 or 5 times normalized earnings and yielding 9 or 10%. We don't expect earnings to completely evaporate. They have been able to maintain earnings. It's been a good test case. Europe has had negative interest rates in many of the developed countries in Europe, and yet banks like a BNP Paribas, like a Credit Suisse, have been able to grow their earnings and book values per share over the last 2 or 3 years, despite the low level of interest rates, because it demonstrates they have other levers to pull. And Mr. Market hasn't recognized this. In the meantime, you have a bank like BNP, which yields today around over 9%, and a French 10-year yield of about negative 40 basis points. So, you know, you're really given, to me and to us at Harris Associates, Oakmark, there's a huge risk-return opportunity here in some of these quality financials.
What about energy, David? Any value there? And some of the other hard-hit places in the market right now as a result of coronavirus fears, airlines, cruise lines. I mean, what does a value investor do with some of the carnage in these groups?
What's kind of interesting to note is we do have some exposure to the travel sector in our international funds. We have a very little energy exposure, just one stock in a small position. But in travel, we have a little more. We have some Ryanair, which is the discount air carrier in Europe. I mean, the last few days, it's been one of the stocks that's bucked the trend. Same with Trip, which is the online travel agency in China. We think it's a really good business. Travel will be a long-term growth story in China. We saw the interruption in 2003-04 in travel in China with SARS. There was an interruption, there will be, but, and we'll have the same thing in the short term here. But the Chinese like to travel, and as income goes up, they like to travel. And a company like Trip has very, very low fixed assets, so there's not a lot of operational gearing. It's an online travel agency. Oddly enough, it's fallen, but not as much as we would have liked. We'd like to, continue to add to our position, but it just, other things have fallen significantly more than Trip. So this is one area which you would expect to be weak and have glaring value, which just not what we'd like to see from a value perspective.